Good morning, everyone. I'm Jill Malandrino, Global Markets Reporter at NASDAQ, and we are here to talk about the evolution of trading and the impact of AI. Happy to introduce Ryan Pannell. Ryan, give some of your background.
I'm the Global Chair and CEO of Kaiju. We're a predictive AI ecosystem that's been focusing on capital markets trading for over half a decade now.
Yeah, and it's so interesting, Ryan, because you and I, when we started our careers prior to media, I was on the institutional equity trading side, back when there were paper and fractions and time stamping and the whole back office reconciliation and so forth. And one of the defining moments having started in the late 90s is when we had to convert April 9th, 2001, which was the final day, into decimal trading. And being green, I'm like, this is going to change how asset management, trading, reconciliation, back office strategy, it's going to completely change how we know the world today, right? Going through 9/11, financial crisis, COVID, all those technology iterations brings us to where we are today. But at the end of the day, it's still the person that is providing that strategy and making those editorial decisions, even with technology like AI and ML, which you've been employing for a number of years.
Yeah, exactly. And it's, you know, when we had that conversion in 2001, like, you lost a lot of edge. There was edge to be found in the system of eights that was gone as soon as we went to pennies, but then you find new edge, right? Now there's market making edge. There was like spreads that you could mess with from the market maker perspective. And I think that evolution has just continued with machine learning AI. Like those sort of pricing edges are by and large gone. Arbitrage scenarios are gone in terms of spread management. And now we're into AI and machine learning, specifically finding patterns in trading data. But as you say, it starts with the trader. Like, we don't just connect these systems to capital markets and say, go make money. I mean, Renaissance Technologies does, and they're quite successful. But when you do that with no ideology underpinning it, they just tend to gamble, which is kind of funny, because people do that. If you say, go make the most money possible, people will bet generally on remote probabilities, and the machine does the same thing.
Right. Well, I mean, you also have to think about your risk tolerance as well. I don't think I'd be able to handle some of those downturns, or relative to what you can make on the upside. The consistency might be more the key. So it's not like you just walk in, flip a switch, and AI does it for you. I mean, you're still going to have those parameters that are put in place by asset managers, and finding that edge. I feel like when you have these efficiencies that emerge from these newer technologies, that's when you start to extrapolate the edge there.
Yeah, it's about refinement, right? I mean, we always start with an underlying trading ideology. It comes from something that one of the traders or myself has been doing for, decades. You teach the machine, you say, okay, let's start with this. Step number one is there actual edge there, or was I just lucky? Because you've used the manual process up until this point. You've looked at scans, you've created these criteria to determine what you're going to invest in systematically, quantitatively, and it's possible that while there were maybe millions of iterations of this, or possible positions you could have taken, you traded like the couple thousand that were actually profitable. So the first step is always, am I good or was I just lucky? And after that, it's maintaining the integrity of the ideology, remaining faithful to the risk parameters that you've set. How far can you push the strategy? And the machine always takes it vastly beyond what we're able to accomplish. If you're selling spreads above and below the market and you have this system that you've employed, it might skew those spreads. It might not trade certain stocks in your asset universe. It's like, no, low probability here, so it always takes it to the next level. If you strip all that away at its most bare, naked strategy, it always gambles, and it's always enormous drawdowns. Like, when we start, there's always like, on a 10-year horizon for a model validation, you have 3 periods where it's like minus 70 or minus 90%. Like, nobody's actually going to sit around and be calm in a minus 70 to minus 90% drawdown.
It's also human psychology. You're going to pull out at that 90%, and then it's going to, ramp up
long before that, right?
3,000%, right? I mean, that's just human psychology. We see it happen time and time again. So a couple of questions for you here. You and I talk about diversity of experience all the time.
Yep.
Do these strategies do they have the ability to execute, let's call it a complex option strategy, right? Is it able to do that? It's not like you're going to put on multiple thousands of options contracts with a very complex strategy and run it through a machine. Are you still working with your counterparties to a certain extent?
Yeah, I mean, on the equity side, 99% of the strategies execute autonomously because they can. There's an API, the spreads are really, really tight, and we have obviously liquidity engines running that can determine best price point for execution. But yeah, on the options side, like there are mostly counterparty conversations. So while the AI system generates the order, the instruction, go do this, you've got your traders calling counterparties and trying to sell, I need to sell 1,500 spreads of this, they're calling Baypoint, Merrill, Goldman, whoever it is that we're trading with, and there's a human transaction that occurs at that level. We're just not at the point with most of the complex options work that we do where it's just automatic.
Right. I mean, you might also want to adjust your strategy as well. Does it give you the opportunity to do that? And my part B to that question is, has this impacted market structure? We know the edge in certain strategies has transformed, but do you think it's had impact to the core market structure?
I think it did earlier on, maybe about 3 years ago, when we had less sophisticated tools. You had sort of machine versus machine reverberation. You're looking for specific patterns in price, time, and quantity that allow you to reverse engineer a trading decision that was made by an enormous asset manager, a dominant market participant, which is likely to determine the direction of the stock. So you're looking for these things. And because the asset manager is using machines to try to hide that decision in their buying or selling, you had sort of like this reverberation where machines reading machine and creating a pattern in response to that. But as the models and systems became more sophisticated, they're actually pretty good at finding themselves in all of those data. Like there's much, much less noise now. And their efficiency is actually useful in tracking them down.
How so? And I think that's a question.
Yeah, they don't.
What are the positive attributes to this?
Because they don't actually act like we do. Like, it still shocks me to this day, like order placement systems that are designed to hide enormous amounts of buying or selling by using price, time, and quantity offsets, right? If you're a huge $1 trillion asset manager and you're going to buy $6 billion worth of some stock, you can't just buy $6 billion of stock, not even unlit. You're going to do this over time, combination of lit and unlit, and try to hide what you're doing. But the systems that do that are actually incredibly lazy, and they do it by creating order flow that no human would create. Odd order sizes. You can watch the unconsolidated order flow. I like to watch it on NASDAQ, and you can see this like 1337, 1337, 1337, like the same off-sized orders over and over and over again, and then a completion order of like 64. You can see that, and the machine will add that up, and what do you get? You get $2 million worth of stock, exactly to the penny. So there you go. That was somebody's order slicing algorithm that was super lazy. Whereas a human won't do that. A human will use truly random offsets. They'll fluctuate their order size, but it's very labor intensive, right? You have a series of executing traders who are sitting there doing that all day long for days and weeks on ends. So that's an area in which increased efficiency has actually created a pattern that's more predatable. If it were me, and I'm not a $1 trillion asset manager, so easy for me to say, but certainly when we place orders, we don't use autonomous systems to slice them. We still use traders to accumulate or distribute based on instructions. The machines give the instruction, the traders do the trading.
Right, so at the end of the day, you're still going to make that executive editorial decision. So another question that I have, let's do some examples here. When it was 9/11, financial crisis, COVID, we understood that those were, let's call it longer term volatility events. But then you see something like August 5th, more recent, so that everyone has some context here. You had that major move in vol, it recovered, market continues to hit new highs, is it because it's this confluence of machines that are either executing relatively the same strategies? And that was my question before, does this impact market structure? And then to follow up on that, it's not like algos or computer design strategies or anything new either.
No, and I think that presently you still have a lot of human-made decisions that are causing market fluctuations. I mean, I could probably count on one hand the number of firms that do what we do. You know, sort of Walleye, Renaissance Technologies, us, a couple of others are 100% AI curated and directed. Most of the firms that are employing AI are frankly using it on the generative side to try to replace the heavy lifting of a large analyst team with varying degrees of success. But pattern predation requires a level of specific expertise that's rare. I mean, most of us, my background is in theoretical physics and applied cryptography. Derivative mathematics PhDs, we have astrophysicists, biochemists, very few financial engineers or guys with backgrounds in financial markets, because there's not a lot of pattern recognition historically outside of market making, right? In terms of liquidity and flow provisioning, like that's where the pattern recognition comes in. For the rest of us, it's a history of random object collision, it's a history of genome sequencing where machine learning was used to efficiently identify a pattern. So like we've got that element, but those systems don't react outside of the parameters we've allowed them to work within. So they don't create vol spikes, et cetera. It's a very human response to external stimuli, is I'm going to immediately take a protective mechanism. Machines are vastly more, I guess, risk tolerant in a number of circumstances. I mean, they panic certainly less frequently. As you can see, anytime you run a raw model that allows like a 90% drawdown, I'd be having a heart attack, which is why we don't do that. Even though at the end of every single time horizon, you've got, you know, something stupid like 30,000% cumulated P&L, but it requires you to sit there and watch 90% of your capital disappear a couple times in the 10 years. I can't imagine watching that and saying, I'm good, it's fine, I'm sure it'll turn around, it always does this. Like, I'd have a heart attack, and your investors would be long redeemed out. So, you know, as soon as you add a layer that says you can't ever lose more than 18% in a sustained drawdown, that 30,000% cumulated P&L becomes like 7,000%. And then the more guardrails you put on, the lower it gets. It's still crazy at the end of the day. I mean, these things have like 52% KGARs. Right. So like they're not your vanilla strategy, but you know, the responsible human element laid on top, we're gonna manage this. The machine doesn't do that because it's been told just to make money.
Yeah, well, I mean, that's how these different parameters also differentiate the strategies as well. And to your point before, where a lot of platforms are incorporating Gen AI to either derive strategies, whether it's on the fundamental or technical side, not to be flippant, but that seems almost not lazy, but I think there's a better way to go about that. Let's use an example that might be a little bit more broad for context. So let's say Apple reports earnings. There's 50 analysts on Apple, let's call it that. At the end of the day, they're updating their models. There's kind of that every quarter that you go through, you know, that 1 week that you're basically sleeping in the office updating your models, and everyone's doing relatively the same thing. So if you can incorporate those efficiencies that Gen AI allows, now you start reading between the lines and extrapolating those fundamental ideas that might not have been identified before because you're using your time to, you know, work on Excel sheets and you know, come up with the latest model. That's where I think it gets interesting. But just to say, let's throw everything through Gen AI, I think you're going to miss some of those extrapolations.
Well, I mean, generative AI is terrible at finding mathematical patterns. I think there's some efficiency there in terms of aggregating data for analysis. But at the end of the day, you know, if you're a fundamental investor, you know, you're probably not going to use predictive AI outside of the actual order placement. And it's, you know, we're not fundamental investors. We don't really care what the company does. We don't care what they make. We don't care what their earnings are. It's completely irrelevant to us. And we trade being first with being, I shouldn't say certain, but more certain. So if you're a fundamental investor and you are combing through fundamental data and you are trying to determine whether positive earnings will be positively received, because they're not always, by the marketplace, if you're trying to determine whether there will be follow-on upward price action, you're going to place an early bet, but your win rate is going to be vastly below 50%, always, because being first is extremely costly in terms of being certain. We don't do that. We look for the patterns that follow the dominant market participants determining the direction of the stock. We're a little later, I mean, not that much later, but vastly more certain.
Yeah.
So I think that's where you have this challenge right now is, one, understanding the role that predictive AI can play, understanding that these types of systematic AI strategies are not niche. At the end of the day, every investment management decision, no matter how complex, I don't care if you had 1,000 analysts working at it, it results in either a buy or a sell. And how you buy or how you sell leaves clues that allow you to reverse engineer, not always, but most of the time, the investment management decision that led to it. If you think that there is an event that is imminent, that you have no time to profit from, then it will be an immediate investment. It's lit, it's messy, it's ugly. You need to be in the position as much as you can, as quick as you can. If you think that NVIDIA is going to trend up 100% in the next 6 months, and you want to take an enormous position, it's going to take you 3 or 4 weeks as a huge asset manager to take that position. Different footprints, different outcome, different analysis on our side.
Which is interesting too, because to your point, where it could take 3 to 4 weeks on the buy or sell side to execute a full position, could that strategy be impacted because strategies employing AI or ML or some sort of algorithm to it could influence the price, as that could also move the market as well? I mean, it could change your fundamental strategy in terms of the execution.
Yeah, I mean, this sort of moves into an ethical question that's now come up for us, and that's sort of primary pattern predation is we're looking for patterns in price, time, and quantity that give us a high degree of certainty that of an up or down direction, and then we're going to follow that. We're also obviously looking at our own market impact from what we do, because we want to do this in the shadows, right? I mean, like, we don't want to leave our own footprint. And so you're starting to see follow-on patterns from our pattern predation. In the initial stages, you're just trying to be invisible. But we have thousands of engines that run on specific tasks. We have regime classification, change detection, execution, liquidity, analysis engines. They all talk holistically. And so the ethical question is, when one of the engines realizes that the pattern that it needs to see to succeed isn't there, but a specific smattering of buying and selling will create the pattern, now you're not predating on an organic pattern anymore. You're actually influencing behavior. Now you're influencing behavior through buying and selling, which at present is not classified as market manipulation. So you're participating in the buying and selling. Nobody has a gun to their head, but that's an awkward question to answer, right? You're not just jumping into the river that's flowing by. You're altering the river so that the specific pattern you need is available for you to predate on afterwards. Right. Are you going to do that or not? Spoiler alert, the answer for us was no, and for 3 reasons. 1 mathematical, 1 egotistical, and 1 ethical. So the mathematical reason is, in over half a decade of doing this, we have seen no top end to the number of organic patterns that we can predate on. So said another way, we don't actually need to manipulate people to feed. There's plenty there for us to transact on. Egotistical, I mean, people, as weird as it seems, aren't drawn to this job for the money. It is a lovely byproduct, but they're drawn to the job because it's an opportunity to, I don't want to, dominate sounds overly egotistical, but be successful in an area that's supposed to be untamable. You are not supposed to beat the markets. They are supposed to be an organic force like the ocean. And so if you're manipulating behavior in order to do that, the satisfaction is much lower. And then on the ethical side, it's, I think, what you're going to see across a number of panels, conversations had over the next couple of days. Future generations are going to judge us based on how we use this technology in the beginning. I think you set a precedent for, well, I mean, no one had a gun to their head. I didn't make them trade. I just kind of, you're like that deep sea fish with the little glowy thing in front. It's like, I just hung it out there and you came to eat it, and sorry about that. I don't think any of us are interested in being that fish.
But which is encouraging to hear, because then it does show that there is an opportunity for a diverse market ecosystem, right? Where it's not just hedge funds or VC that has the edge. You can create these edges elsewhere. I mean, look at your background, right? You are using your background in terms of establishing patterns in what you're pulling from your scientific work. And I'm sorry, some of that kind of my eyes glaze over when you talk about some of those things, but you're leveraging that in perhaps a career objective that you probably never thought of when you thought, okay, I want to do PhD work, I want to do more of the science, the physics work, but this makes a lot of sense when you start applying it to areas of the financial markets. I mean, why wouldn't you capitalize on that, if you will?
Yeah, I mean, I think everybody comes to it from a different perspective. Mine was that I didn't like being personally responsible for the investment outcomes. I mean, as a professional trader starting out, yeah, I used quantitative processes, but they were manual strategies, manually managed, and at the end of the day, you wear the outcome of that decision, right? You have a bad week, those were your decisions, you're all down, you're doing lots of meditation, you're going for long walks, but you're generally miserable. You have a fantastic week, you're a rock star, you're awesome, I have conquered the market. I hated that, and completely systematic trading, specifically AI, curated and directed trading, you're just working off of probabilities, and you combine a higher probability of A happening over B with an asymmetrical return on risk, and that just prints money. It sounds flippant and silly to say, but that is how those systems work. So at the end of the day, if it's a bad week, those are baked in to the system. That's not my bad week. That's just a bad week for that system given the challenges of that market. And next week is a good week, and the week after is a great week, and then you've got a terrible week, and on and on and on it goes, and I sleep well at night. Some of the other guys are just at a granular level involved in cracking the code or solving an unsolvable puzzle. Everyone's driven by something else, but taking advantage of the market isn't a driver, for us at least.
Behavioral finance is, it definitely is. It can be exhausting when it comes to the mind, but let's talk about something a little bit existential here, because we're here at Rally, we're talking about cross-sector emerging technologies and where the convergence of that is. And at the end of the day, it all comes back to this massive data that we're collecting, whether it's in, it's out, clean data. What can we do with these? On my show last week, I had someone a neurosurgeon from Stanford, talking about how they're using this type of data to bring down the risk percent in complex surgeries because of robotics, because of automation and so forth. But it's essentially what we're doing here when it comes to the capital markets, is being able to use this structured data to make better educated decisions and know, to your point earlier, okay, I had a bad week, but at least there was something structured behind it that helped me make those decisions. And I think it makes sense, particularly where we are right now, where the consumer vernacular, Gen AI in general, is what we're talking about, which is why it's mainstream, right? But at the end of the day, we're using this data to make better quantifiable decisions and think about our ROI and the solutions attached to that. And you just don't want to do AI for the sake of AI. What problem are you looking to solve? How is it going to make the data that we use in, out, more ethical, more responsible? What are we going to learn from it? How are we going to make better decisions? How are we going to be able to quantify that when we think of our ROI and what the next step is in evolving our strategy? That's powerful.
Yeah, and I think we're lucky in capital markets trading in that you have a very robust closed data set, which is where, again, the predictive versus generative AI largely using comb data from unconstrained sources, which results in what we call the jelly bean problem, which is I create some robot, right, and call him Fred, and I send Fred to the jelly bean store, and I want an example. I want one of every single jelly bean in the jelly bean store. Now, I've never been to the jelly bean store, so I don't know how many jelly beans there are in the store, and I'm hoping that I programmed Fred well enough to go and bring me one of every jelly bean. But what if I didn't tell Fred that jelly beans could come in circular jars as well as square containers? What if I didn't allow for a second floor in the jelly bean store? What if I gave him loose shape parameters so he brings me a bunch of peanuts which sort of look like jelly beans? When it comes back and it gives me these 64 jelly beans that I can choose from, how do I know that that's representative of everything? That's generative AI using the internet to pull data. Unless you manually verify the integrity of the data set, you don't know what that is. That's not the case for capital markets trading, because we're using price, time, and quantity, which are sourced from a number of independent sources and can be easily compared. I mean, we buy from you guys, we buy from Morningstar, we buy from ICE, we buy from Spider Rock, we buy from SIBO, and when we compare absolutely everything, yeah, no offense, but there are deficiencies in the data. That's why we have a data sanitization team. Nothing is 100% clean, but the aggregate of all of those sources allow us to create a complete, absolute picture of every print that's ever been traded on the domestic markets. So we have an enormous amount of, unlike the jelly bean problem, we have an enormous amount of certainty that the pattern that we see there is there. That's everything. That's a complete picture of what we have to use. And so I think that's where, you know, any discipline, medical imaging and diagnostics, something we've started working on, which is autonomous maritime navigation. You have the same closed data set. It's variable, but you have, you know, wind, tide, time, surge, surf. These aren't unknown quantities. You can either collect the data at source, or you buy the historical data, and this allows you to be highly accurate. So predictive AI has that ability. It can't talk to you. It doesn't do the, it's not going to write a novel for you, so it's a little less sexy, I think. But in terms of applicability, at least in investment management, it's a huge advantage that's right now underlooked.
And that was my question to you. Can you apply the underlying technology, Kaiju, can you apply that to other industries? You had mentioned maritime. Are there other areas that you can use it in? Or, if we lift the curtain back, are you thinking of other sectors that it could be applied to?
Yeah, absolutely. The ones that I just listed, whole home control and automation. I mean, most of us have a wearable now that we wander around with. We're mostly completely connected to the internet. Like, your movements, your blood pressure, your temperature connected to your home. We're a stone's throw away from your Apple Watch telling you that you're probably coming down with a cold. And if you had an entirely smart-enabled home, I mean, it knows where you are, so it sees you coming home. This is one of 3 commuting routes he takes. Is he on his way home? The whole house is like 60 degrees. Oh no, he's coming home. I'm gonna boost the temperature, I'm gonna run the bath, I'm gonna microwave that soup. Like, you're not far away from doing that.
There's no sneaking out anymore.
Yeah, there's a world of manufacturers, Honeywell, et cetera, that can create the types of systems that would do that. And you build a behavioral model. What's the gotcha for that? Well, now security becomes a vastly more important thing, right? If there is a well-structured, well-defined behavioral model for you, where are those foundational data stored? On your home server? Like, if I want to know everything about you and your movements and your habits, it's in that profile. So it's that exchange of, like, the more powerful the profile, the easier my life is going to be, because this system can learn enough of my habits to make life a lot easier for me. It can probably also help somebody to manipulate me at some level. But those are the types of systems that predictive AI excels at. Write me a dinner invitation for a theme party in Victorian English. It's not going to do that. It's not even capable of doing that. So.
I mean, it's good for a jump-off point. If you want to, I feel AI certainly, from the consumer perspective, it helps you to organize your thoughts and create a framework, which could take, like, writing a job rec. Those are a pain to do. It takes 2 to 3 hours. You're trying to figure out, what goes where. Quick jump-off. You can finish it in 10, 15 minutes, and then you can work on stuff that's important, like strategy or whatever it is. But I'm glad you brought up the security part of the conversation because, again, being at a cross-sector conference, it all converges again with data privacy, governance, cybersecurity, and at the pace that we're moving with these emerging technologies and either, what is a problem you're looking to solve versus attaching, we have this within our, AI within our ecosystem, or are we thinking about, the risk management and testing side of the house versus deploying technology just to say that we have it? And I think we're at that inflection point where, whether it's trading, but I mean, healthcare is another one too. I mean, that's the most personal, impactful data that you have. So, I wonder if that's going to be something that's incorporated down the line in these conversations because, the data and the technology just manifests itself with each iteration.
I mean, cloud computing really paved the way for this anyway. So in terms of data integrity and securing systems, like that road was paved 10 years ago
right.
by smarter, better people. So I'm grateful that preceded this, so that we don't have to consider that in the same way as we do now. And certainly coming from a cryptography background, you don't have a lack of expertise in making sure that your data are safe.
So when you think about this, and again, this conversation, if we're having it here, 12 months from now, 3-5 years, I think it's going to look really different because things are evolving so quick, and how it's being adopted in different sectors and cross sectors, which I think it's so interesting here. Some of the conversations might pull similar concepts. So what's your outlook here? How do you see this evolving, whether it's specific to capital markets or more holistically?
Yeah, I think one of the things that's starting to change is the overall comfort level with how machines make investment management decisions. This has been a sticking point for us and why we've stayed sort of niche and specialized for years. Our original investors fell into one of two categories. They were either tech entrepreneurs or they were the single family offices of exited tech entrepreneurs. Like, that was it. Because they got the technology instantly, they understood the value of having machines make these dispassionate decisions and not having a human actually performing the investment decision, but managing the counterparty relationships. But everybody else finds the way machines make investment management decisions really disquieting, because humans follow this linear logic path when we make an investment decision. Like, you perceive an opportunity, you do a bunch of research, you gather information, maybe you talk about it with a team, maybe you talk to peers, you review comps, and then at the end of that trail, you either buy or sell. And the machine takes in all the data simultaneously, performs billions of independent examinations simultaneously, and then makes a decision based on the weighting, the aggregate weighting of 1,000 criteria. And it's not explainable at the end of the day. It's well, why did you buy this? Humans can walk you through the decision. I did this, I did this, I did this, I did this, I did this. The machine is like, my portfolio would be better with this or wasn't better with it in my estimation based on these 1,000 weights that are always dynamically changing. We don't like that, which is really weird because as humans, we do this with every qualitative decision we ever make in our whole lives. Like, if you walk into a room, you see an attractive person, you're like, wow, that person's really attractive. Or you hear a song and you think, I love that song. Or you have a bite of food and you say, that food is delicious. If I stopped you in the moment and I said, oh, fascinating, why? You would sort of fumble around with the answer. You try to come up with it. Oh, well, I don't know, her smile is, but it's absolute nonsense. You knew it instantly. Your brain performed the same 1,000 discrete examinations simultaneously. Your informed subconscious said, yep, I like that. But we can't do that with investment management, so we find that disquieting. Our limitation is actually what leads to the disquiet we have over how machines make the investment management decision. And so what ends up happening is that you have this toe-in or wait-and-see approach where people say, oh, I don't know about this, but it sounds fascinating, I'm going to invest X. And then, it plays out over the coming months, and people say, wow, that was actually really profitable, cool, I'm sold now. And we're never surprised by that. The fact that the real-time performance of any system we build completely one-to-one overlays the model is not shocking to us. That's how these systems work. So we're starting to see the very beginning of a tipping point with that, where people are more comfortable, especially I mean, I won't lie, I've used that analogy like 3 times at these things now, and it generally resonates because people think, yeah, I totally do that. And it's not like we do that with just, silly decisions like soup or a song. People move to another country based on like how they feel. They start intimate relationships based on how they feel. They make enormous life-changing decisions. Which university? What house did you want to buy? Did you buy that car? Are you going to take this loan to achieve this goal? Based on these sort of qualitative inputs. So it's weird that we don't feel comfortable handing our wallet over, but we'll like commit to trying to build a life together based off the same sort of thing.
Right, which is so interesting because it removes the subjectivity of it, right? So it's more objective, and I also think from the qualitative, or let's call it more fundamental perspective, whether it's investing or social or political views, you get into these echo chambers that feed you, they tell you what you want to hear, always like yes people versus okay, maybe you want to take a step back and let's challenge what your thesis is behind that. Like I had asked you before in terms of how this is impacting market structure, and those types of challenges to your qualitative analysis doesn't necessarily make it a better or worse investing decision. It's always going to be subjective at the end of the day. If I like NVIDIA at this price, you may not, but the objectivity of the platform is going to help to identify those patterns so you make a better decision, which, based on the patterns that you've identified, is going to perform better over X amount of time.
Yeah, exactly. And it's one of the reasons that we, I think, tend to hire unaligned scientists who have experience in machine learning, because there is, and you know this, I know this because we've both been traders, like you do what your mentor taught you to do, what the first desk you sat on taught you to do. You evolve over time, but there's a bit of a herd mentality. If you've been taught a specific strategy, series of strategies, asset class that you are effective in, you tend to continue doing that thing. And you get a bit of tunnel vision. And when you pull people in who are extremely experienced with machine learning, but not capital markets, it doesn't take a lot of time to learn capital markets, asset classes, order flow, liquidity. I mean, they come into it completely blind, but if you can sequence frog genomes, you can learn how to trade capital markets. There's a little heavy lifting sometimes. We'll meet with our scientific team and you say things like, this guy Charlie's working on an index options problem, and you say, oh, well, but don't worry about that, Charlie. Index options are cash settled. You don't have to worry about that. He'll nod his head, and then the little notepad comes in, and you're like, are you writing down that index options are cash settled? Yes, I am. He's gonna.
So that's something I would do. So okay, explain to me. Well, if I don't write things down, I don't remember anything. So explain this to me on a higher level. Like explain to me like I'm a 5-year-old. Let's use an example of how you take your science background and apply it to a capital market strategy. Like you had mentioned before, genome sequencing. What does that mean in the capital markets world? How would you apply that to an equity strategy?
Yeah, so I mean, so my background in random object collision theory, let's use an easy example. So a defense contractor will employ somebody like me, as sad as this is, to try to predict the shrapnel pattern of an explosive device, right? I mean, this is an organic chemical reaction that happens. You can't specifically control where each piece of this thing will go, but through different structures, you can largely predict an effective distribution of explosive material and the shrapnel that is ejected from that. It's not dissimilar from taking volume pressure, which builds in equities, and price distribution patterns, and trying to predict where this price will go as a reaction to the volume pressure that's created. And so I am not a biochemist. I have no idea how Charlie uses his genome sequencing for our options work. From the results, he's clearly really good at it. He could sit on the stage and I'm sure talk about it a little more, but it's a process of finding a repeating pattern, and patterns are about efficiency, right? I mean, there's just 2 types of pattern. There's intentional or unintentional. Intentional patterns are used to obfuscate or create an efficiency, right? I'm either trying to hide something and I'm going to use a pattern to hide it. Camouflage is a good example. Exists in nature, we create it ourselves. The seams on a carpet, if this was a patterned carpet, you're trying to hide this recurring pattern, or these unintentional patterns, and those are a byproduct of behavior. So when you're trading in capital markets, I'm trying to achieve an objective and I'm unintentionally creating a pattern in the achievement of that objective. So any discipline that has a high level of efficacy in finding a pattern in otherwise seemingly random material, that's going to be useful in capital markets trading.
Which is so interesting, even when you think about the skill sets, how you're bringing in more science into capital markets. It's not, putting A matches A and B matches B and you have to, you get your MBA and boom, you're into the capital markets. I mean, you're able to pull from multiple disciplines. And again, that's what differentiates the edge at the end of the day. You're looking at it from a different perspective versus, PE and valuations and so forth. That's where the edge comes in by employing other disciplines into something you wouldn't normally associate it with.
Exactly, and that's today, talent acquisition is a huge part of what we do.
We're all competing for somewhat of the same
the top talent, and there's no PhD in machine learning, right? There will be at some point,
just enough academic
but there isn't a formal course of study. So what you're finding are mathematicians or physicists or biochemists that have used machine learning to find patterns in whatever it is they do. But I mean, like, we've spent 6 years now building a formal relationship with Imperial College London, with University of Zurich. So now every machine learning aligned candidate at the MSc or PhD level at Imperial College comes through our program. The first year that we did this, capital markets trading 2019, we had 6 applicants, which is about 10% of their machine learning aligned candidates. And last year we had 65, which was 100%. So, I mean, there's a lot of interest in getting access to this. And again, they're largely not coming into this because they want to be rich. They're coming into this because they want to apply their craft, trying to solve an otherwise unsolvable puzzle. But that's the game these days. I mean, it looks like recruiting kids for sporting teams at like 13 years old. That's what we're doing. Hey, congratulations on the robotics award that you won with that. How's your mom doing? Does she need help with groceries? I mean, we don't do that, but that's where this is headed. There's going to be talent scouts at that level. Which
is so interesting too, because once this academic work starts to be published, and again, obviously it's not just for capital markets, but being applied to different disciplines as well, it's almost like, research begets more research, right? And I think once you start to get academia involved, that's when you start to think about it in a very different perspective. I mean, just think about capital markets now, once there's more academic research available and so forth, and you build upon that. I mean, it could look different a decade from now based on how these theories are being applied.
Yeah, I mean, these talks that I'm currently doing seem new now, but I have no doubt that in 2 years, much of what I'm saying will it's just going to be common knowledge. Like, people, whether they're involved in capital markets, trading, asset management, or otherwise, the efficacy of predictive AI, pattern recognition, in things that we don't think should be, I guess, I don't want to say predatable because we're talking about human behavior here. If there weren't patterns in human behavior on a larger scale, psychotherapists, behaviorists, cognitive therapists would not have jobs. Books like whatever that, men are from Mars and women are from Venus, that wouldn't sell, right? It's because as complicated as we think we are, and on a granular level, we really are very complicated, we tend to fall into observable buckets of patterned behavior, whether it's relationships, whether it's growth, whether it's investment. And, I hate to say that they're all manipulatable. I think to some extent they probably are. They're at least all observable. And that's what I think we'll probably become more aware of in the future.
All right. Well, thanks so much, Ryan. It was great meeting with you. And thank you, everyone, for joining us. Have a great rest of the day.
Thanks, Jill.
Awesome.